Welcome to the series of videos on fundamental valuation of gold and silver miners, looking at their Q4 2021 results. This series will cover a couple dozen of miners, but only a fraction of these miners will be made public on YouTube, and that with a 1 or 2 week delay. For timely updates on all miners, join us at myfinanceteacher.org. Today we are going to look at Agnico Eagle, AEM, one of the top 3 largest gold mining companies in the world. Our fundamental valuation of gold and silver miners is based on these valuation factors, including the price of gold, silver and copper based on the respective ratios. The model also includes the amount of reserves and resources that the miners have in the ground, including the costs of extracting those reserves and resources in the form of all-in sustaining costs. We subtract the long-term debts as well as taxes, and we look at per share value, taking into account time value of money and the amount of insider shares. So as you see, it's not an exhaustive list of factors that can affect the valuation of a miner, especially market price of the shares, which can fluctuate from day to day and from week to week. But these are the main factors that would affect the valuation in the longer term. I'm going to include 3 scenarios for the valuation, including the balanced scenario with a gold price of $1,900, conservative scenario with a gold price of only $1,600, and an optimistic scenario with a gold price of only $2,200, and the corresponding silver and copper prices based on the relative ratios. And as you see, even our optimistic scenario is not out there, it's not extremely optimistic. I have mentioned in some of my older videos that I do expect gold significantly beyond $2,000, much closer to $3,000 over the next couple of years. So even our optimistic valuation here is not overly optimistic, and in general all 3 scenarios lean more towards the conservative side. Looking at the reserves and resources that Agnico Eagle has in the ground, they have 44.6 million ounces of proven and probable reserves of gold and 39.6 million ounces of measured and indicated resources of gold. In addition to that, they also have inferred resources, but we don't include these into any of the scenarios into the model at all. So again, the whole model in all of the 3 scenarios is again leading slightly more towards the conservative side. Agnico also has 27.8 million ounces of proven and probable reserves of silver, 44.4 million ounces of measured and indicated resources of silver, and nearly 188 million pounds of copper reserves, as well as nearly 120 million pounds of copper resources. Looking at the metals prices, we see that most of the value here is in gold, whereas silver and especially copper account for a relatively small fraction of the company value. Looking at the costs, debts and taxes, Agnico, according to the guideline for 2022, expects all-in sustaining costs at $1,025 per ounce. And Agnico has a long-term debt of over $1.4 billion with a B. For taxes, I just assume a flat tax rate of 20% for all of these minor valuations for the sake of simplicity. Looking at per share value, the number of shares outstanding is nearly 455.6 million shares. And I include the insider shares, which helps with alignment of the incentives and with insiders being more aware of what's happening to the company. A larger percentage here is a positive sign for the valuation. Looking at time value of money, we're going to apply a discount rate of only 5%. Let me know down in the comments below if it's an appropriate discount rate in your opinion. At the expected annual production for 2022, the reserves, only proven and probable reserves, are going to last for about 14 years, whereas if we add only half of measured and indicated resources, reserves and resources altogether are going to last for about 20 years. So these are the timelines for our discounting. Before we have a look at the actual valuations produced by the model, let's have a look at the highlights which are not actually included in the calculations within the model, but might still affect the fundamental valuation in some way. First of all, the cash balance is pretty healthy, although not as large as with Newmont and Barrick. For Agnico, the cash balance is $196 million, which is still pretty healthy. A good liquidity is generally a good sign for a miner. And Agnico being in the group of the largest gold miners, of course, they do have a very good exploration potential. So the reserves and resources that we have seen a minute ago are likely to expand over the years. Another very interesting factor here is that Agnico expects $500 million of buyback within 2022. So this additional buy pressure for their shares is likely to help elevate the share price during this year. Perhaps that might actually give a bit of a bump to our fundamental valuation here. Finally, looking at our valuations, let's start with the conservative valuation, where we plug a gold price of only $1,600, and we only look at the proven and probable reserves of gold and silver without taking into account any of the resources that the miner has. So this valuation is truly quite conservative. So looking at the discounted per share value after costs, debts, and taxes, we arrive at $30.87, which is actually less than half of the current market price as of today, which is an indication of the risk level here in case if gold were to just drop out of bed from here, from around 1970 all the way down to 1600. Is that very likely? Not with historically high inflation that we're observing right now. Next, looking at the balanced valuation, we plug in the gold price of $1,900, and even though this is a balanced valuation, we still only look at the proven and probable reserves in the ground without including any of the resources. So we are still leaning towards the conservative side here, and the discounted per share value after costs, debts, and taxes is $47.92. which is still quite a bit below the ongoing market price around $65. So does that mean that Agnico at the moment is a little bit overpriced, although not that far from fair value? Perhaps. Let me know down in the comments below. And looking at the optimistic valuation, we plug in the gold price of $2,200, and in addition to the proven and probable reserves, we only include half of the measured and indicated resources, as those are less certain, and we still do not include any of the inferred resources, as well as any future potential exploration results. So we are not overly optimistic here, and our discounted per share value after costs, debts, and taxes is $83.29. So clearly, if gold price finally goes back above $2,000 and stays there for a while, if $2,000 turns from being a long-term resistance to long-term support, it will still be quite an attractive return with even some of the larger miners. For more details, look at myfinancesteacher.org. Have a nice day. Bye-bye.